This is breaking news that will affect 68 million Americans receiving Social Security benefits. President Trump has announced that effective 16th February 2026, Social Security benefits will no longer be subject to federal income tax. That means starting this month, if you're receiving Social Security, you keep more money, potentially thousands of dollars more. But before you celebrate, I need to explain exactly what this means, who benefits, who doesn't, and what you need to do right now to maximize your savings, because this policy change has details that the headlines aren't explaining. And if you don't understand the details, you could miss out on thousands of dollars. My name is Katie, and I'm a lawyer specializing in elder law and estate planning. Today, I'm going to break down this announcement line by line. I'm going to show you exactly how much money you'll save. I'm going to explain who qualifies and who doesn't. And I'm going to tell you the 3 things you must do immediately to take full advantage of this change. Let me start with exactly what President Trump announced. On February 16th, he signed an executive order eliminating federal income tax on Social Security benefits effective February 1st, 2026. This is not a proposal. This is not a campaign promise. This is an executive action that is now in effect. Here's what this means in simple terms. Prior to February 2026, Social Security benefits were taxable income for millions of Americans. If you earned other income beyond Social Security, your Social Security benefits could be taxed at rates up to 85%. Starting February 2026, Social Security benefits are no longer counted as taxable income for federal tax purposes. This is a massive change. Let me give you some context on how Social Security taxation worked before this announcement. Before February 2026, Social Security benefits were taxed based on your combined income. Combined income is calculated as your adjusted gross income plus non-taxable interest plus half of your Social Security benefits. If your combined income was below $25,000 for single filers or $32,000 for married filing jointly, no tax on Social Security. Between $25,000 and $34,000 for single filers, or between $32,000 and $44,000 for married filers, up to 50% of benefits were taxable. Above $34,000 for single filers or $44,000 for married filers, up to 85% of benefits were taxable. These thresholds were set in 1983 and 1993. They were never adjusted for inflation. That means more and more seniors were paying taxes on Social Security every year as incomes rose with inflation, but the thresholds stayed frozen. President Trump's executive order eliminates all of this, regardless of your other income, regardless of your combined income calculation. Social Security benefits are now entirely tax-free at the federal level. Now, let me show you the real numbers. How much money will this save you? Let's start with a typical example. Mr. and Mrs. Johnson are both 70 years old. Mr. Johnson receives $2,800 per month in Social Security, $33,600 per year. Mrs. Johnson receives $1,500 per month, $18,000 per year. Together, they receive $51,600 per year in Social Security. They also have other income. Mr. Johnson has a small pension of $15,000 per year. They have interest and dividends from savings of $8,000 per year. Their total income is $74,600 per year. Under the old rules, before February 2026, here's how their taxes worked. Combined income calculation. Adjusted gross income, $23,000. Pension plus interest plus half of Social Security, $25,800. Combined income, $48,800. Because their combined income exceeded $44,000, married filing jointly threshold, up to 85% of their Social Security was taxable. That's 85% of $51,600, which is $43,860 in taxable Social Security benefits. Their total taxable income, $23,000 other income, plus $43,860 85% of Social Security for $66,860. At a 12% federal tax bracket, they paid approximately $8,023 in federal income tax. After Trump's executive order, February 2026 forward, Social Security is no longer taxable. Their taxable income is now only their other income, $23,000. At 12% federal tax bracket, they now pay approximately $2,760 in federal income tax. Annual savings, $8,023 minus $2,760 equals $5,263 per year. The Johnsons will save $5,263 per year in federal taxes starting February 2026. Over 20 years of retirement, that's $105,260 in savings. That's life-changing money. Let me give you more examples across different income levels. Example 2, single senior with modest income. Social Security $1,800 per month, $21,600 per year. Other income $10,000 per year, part-time work. Old tax $2,400 per year. New tax $1,200 per year. Example 3, wealthy couple with high Social Security. Combined Social Security $6,000 per month, $72,000 per year. Other income $100,000 per year, pensions and investments. Old tax $24,000 per year. New tax $14,000 per year. Annual savings $10,000. Example 4, single senior, Social Security only. Social Security $2,000 per month, $24,000 per year. Other income $0. Old tax $0, below threshold. New tax $0. Annual savings $0. No change, wasn't paying tax before. As you can see, the savings vary dramatically based on your specific situation. High-income seniors with substantial other income beyond Social Security will save the most. Seniors who only receive Social Security and have no other income were already paying no tax. Let me be very clear about who benefits from this change and who doesn't. Who benefits the most? 1. Dual-income senior couples. If both spouses receive Social Security and you have additional income from pensions, investments, or part-time work, you likely paid significant tax on Social Security. Now, this change will save you thousands per year. 2. Seniors with pensions. If you receive a pension in addition to Social Security, your combined income probably pushed you into the 50% or 85% taxation range. You'll see substantial savings. 3. Seniors with investment income. If you have dividends, interest, capital gains, or rental income, you are probably paying tax on 85% of your Social Security. This eliminates that tax burden. 4. Working seniors. If you're still working part-time or full-time while receiving Social Security, your wages likely triggered taxation on your benefits. That tax is now eliminated. 5. High-earning retirees. Ironically, wealthier retirees with six-figure incomes benefit the most in absolute dollar terms. If you're receiving maximum Social Security, $4,873 per month in 2026, and have substantial other income, you could save $8,000 to $12,000 per year in taxes. Who benefits least or not at all? 1. Low-income seniors with Social Security only. If your only income is Social Security and it's below the old thresholds, $25,000 single or $32,000 married, you weren't paying tax anyway. This change doesn't affect you. 2. Seniors below the taxation thresholds. If your combined income was low enough that none of your Social Security was taxable under the old rules, you see no benefit from this change. 3. Future retirees not yet receiving benefits. If you're under 62 and not yet receiving Social Security, this change doesn't affect you yet. It will affect you when you start collecting benefits, but that's years away. Here's something extremely important that the headlines are not emphasizing. President Trump's executive order only eliminates federal income tax on Social Security. It does not affect state income taxes. Currently, 38 states do not tax Social Security benefits at all, but 12 states do tax Social Security to varying degrees. States that tax Social Security benefits as of 2026: Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, Vermont, West Virginia. If you live in one of these 12 states, you need to understand that Trump's order does not change your state tax situation. You will still owe state income tax on your Social Security benefits according to your state's rules. For example, if you live in Minnesota and you are paying $2,000 per year in federal tax on Social Security and $500 per year in Minnesota state tax, Trump's order eliminates the $2,000 federal tax, but you still owe the $500 state tax. Some states may choose to follow the federal change and eliminate their own Social Security taxes. Connecticut, for example, has already announced they will mirror the federal policy, but most states have not made announcements yet. If you live in one of these 12 states, you need to contact your state Department of Revenue or a local tax professional to understand how this federal change affects your state tax situation. Now, let me tell you exactly what you need to do immediately to take advantage of this change. Action 1. Adjust your withholding. If you currently have federal income tax withheld from your Social Security check, you need to reduce or eliminate that withholding immediately. Social Security is no longer taxable, so you don't need to withhold tax on it anymore. To change your withholding, you need to complete Form W-4V, Voluntary Withholding Request, and submit it to the Social Security Administration. You can do this online through your My Social Security account, by phone, or by mailing the form. Important: don't eliminate all withholding if you have other taxable income. You still need to pay estimated taxes on pensions, investment income, and wages. Only eliminate the withholding that was covering your Social Security tax liability. Action 2. File amended returns. This is crucial and time-sensitive. The executive order states that the Social Security tax elimination applies to benefits received on or after February 1st, 2026. But it may also allow for refunds of taxes paid on Social Security benefits received in 2025. The IRS is expected to issue guidance on whether 2025 taxes can be refunded. If they announce that refunds are available, you will need to file an amended tax return, Form 1040-X, for tax year 2025 to claim your refund. Here's why this is time-sensitive. Amended returns must typically be filed within 3 years of the original return's due date. For tax year 2025, filed in early 2026, you have until April 15, 2029 to file an amended return. But the sooner you file, the sooner you get your refund. If you paid $5,000 in federal tax on your 2025 Social Security benefits and the IRS allows refunds, you could get that $5,000 back by filing an amended return. Don't wait. Start preparing your amended return as soon as IRS guidance is issued. Action 3. Recalculate your retirement withdrawals. If you've been using a tax calculator or retirement calculator to determine how much money you can safely withdraw from your retirement accounts, you need to recalculate now. Your effective tax rate just drops significantly if you are paying tax on Social Security. That means you might be able to withdraw more from your IRA or 401k without jumping into a higher tax bracket. For example, if you were carefully managing your IRA withdrawals to stay in the 12% tax bracket, and you are paying tax on 85% of your Social Security, eliminating the Social Security tax creates more room in that 12% bracket. You might be able to withdraw an additional $10,000 to $20,000 per year from your IRA before hitting the 22% bracket. Work with a financial advisor or tax professional to recalculate your optimal withdrawal strategy under the new rules. I need to address the elephant in the room. Can the president eliminate Social Security taxation by executive order? Is this legal? Will it be challenged? From a legal standpoint, this is complex. Social Security benefits have been subject to federal income tax since 1983, partial taxation, and 1993, up to 85% taxation. Those taxation rules were enacted by Congress, not by executive order. Generally, a president cannot unilaterally change tax law. Tax law is set by Congress. However, the president does have authority over how the IRS enforces and administers tax law through executive orders and administrative guidance. The legal theory behind this executive order appears to be that the president is directing the IRS not to collect tax on Social Security benefits, rather than changing the underlying tax code. This is similar to how President Trump previously directed the IRS to defer payroll tax collection in 2020. Will this be challenged in court? Probably. Legal experts and some members of Congress have already raised questions about the constitutional authority to make this change without congressional approval. If you're worried about whether this change will stick, here's my advice. Take advantage of it while it's in effect. Adjust your withholding. File amended returns if refunds become available. Recalculate your retirement withdrawals. If the courts strike down the executive order in the future, you can always adjust again. But don't miss out on potential savings now because you're worried about what might happen later. Beyond the immediate tax savings, this change has significant long-term implications for retirees and retirement planning. Implication 1. Social Security Trust Fund. Social Security taxes on benefits generate approximately $50 billion per year in revenue that goes back into the Social Security Trust Fund. Eliminating this tax removes that revenue source. Some analysts worry this could accelerate the trust fund's projected depletion date, currently estimated at 2033 to 2034. However, proponents argue that letting seniors keep more of their benefits stimulates the economy and generates other tax revenue that partially offsets the loss. Implication 2. Retirement planning calculations. Every retirement calculator and financial planning software assumes Social Security benefits are taxable for many retirees. Those assumptions are now wrong. If you've been planning your retirement based on after-tax Social Security income, you need to recalculate. You may be able to retire earlier, save less, or spend more than you previously thought. Implication 3. Roth conversion strategies. Many retirees have been converting traditional IRA money to Roth IRAs to manage their future tax liability. Part of that strategy involved paying tax on Social Security. If Social Security is no longer taxable, the calculus around Roth conversions changes significantly. You may want to slow down or pause Roth conversions and leave more money in traditional IRAs. Implication 4. Working in retirement. Previously, some seniors avoided working in retirement because earned income would trigger taxation on their Social Security benefits. With that concern eliminated, more seniors may choose to work part-time, which has both financial and health benefits. As seniors adjust to this new policy, I'm already seeing some common mistakes. Let me help you avoid them. Mistake 1. Eliminating all tax withholding. Just because Social Security is no longer taxable doesn't mean you have no tax liability. If you have pensions, IRA withdrawals, investment income, or wages, you still need to pay tax on that income. Don't eliminate all withholding or you'll owe a big tax bill in April. Mistake 2. Assuming state taxes are also eliminated. As I explained earlier, this only affects federal taxes. If you live in one of the 12 states that tax Social Security, check your state's policy. Don't assume your state automatically follows the federal change. Mistake 3. Not filing amended returns. If the IRS allows refunds of 2025 Social Security taxes, don't miss the deadline to file your amended return. Set a reminder. Check the IRS website regularly. Don't leave money on the table. Mistake 4. Over-adjusting retirement withdrawals. Yes, you can potentially withdraw more from retirement accounts now, but don't go crazy. You still need to make your money last for 20, 30 years of retirement. Work with a financial advisor before making major changes to your withdrawal strategy. Mistake 5. Not telling your tax preparer. If you use a tax preparer, make sure they know about this change. Some preparers may not be up to date on the latest policy. Tell them explicitly, Social Security is no longer taxable for federal purposes starting February 2026. Make sure they calculate your taxes correctly. I need to be honest with you about the uncertainty surrounding this change. This is an executive order, not a law passed by Congress. Executive orders can be challenged in court, reversed by Congress, or canceled by a future president. There is no guarantee this policy will remain in effect permanently. Congress could choose to codify this change into law, making it permanent. Or Congress could pass legislation overturning the executive order. Or a court could rule that the president lacks authority to make this change without congressional approval. What should you do, given this uncertainty? My advice: enjoy the savings while they exist, but don't make irreversible financial decisions based solely on this policy. For example, it's fine to reduce your tax withholding and enjoy more take-home income each month. But don't make a massive, irreversible investment decision like buying an expensive house or gifting large sums to family based on the assumption that Social Security will remain tax-free forever. Plan conservatively. Hope for the best. Prepare for the possibility that this policy could change in the future. Here are resources to help you navigate this change. IRS website. Check irs.gov regularly for official guidance on the Social Security tax elimination. The IRS will publish FAQs, forms, and instructions. Social Security Administration. Visit ssa.gov or call 1-800-772-1213 to adjust your tax withholding. Use your My Social Security account online to make changes quickly. State Department of Revenue. If you live in one of the 12 states that tax Social Security, check your state's Department of Revenue website for information on how they're handling the federal change. Tax professional. Consider consulting a CPA or enrolled agent who specializes in retirement taxation. The cost of an hour consultation could save you thousands in taxes. Financial advisor. Work with a fee-only fiduciary financial advisor to recalculate your retirement plan under the new rules. Don't make major financial decisions without professional guidance. This is a significant change that will put more money in the pockets of millions of seniors. If you're receiving Social Security and you have other income, you will likely save hundreds or thousands of dollars per year starting February 2026. But you need to take action. Adjust your withholding. Watch for IRS guidance on amended returns. Recalculate your retirement strategy. Don't let this windfall slip through your fingers because you didn't understand the details. I'm Katie, and this is the Flux News. My goal is to help you understand complex changes like this so you can make informed decisions. If this video helped you understand how Trump's Social Security tax elimination affects you, please share it with other seniors who need this information. Subscribe to this channel for updates as more guidance is issued. This is a developing situation, and I'll keep you informed of any changes. Thank you for watching. Keep more of your money.